Have you ever sold a product to a customer and later the customer returned it because it was damaged? Most business owners don't know how to properly record this transaction. As a result, their sales records become inaccurate and they don't know the actual profit. Watch the end of this video because I will show you the simple document business use to solve this problem. Hello everyone, welcome back to Excel with Marvel. This is the 6th of our 90 days bookkeeping challenge where we are learning practical bookkeeping step by step using a real Nigerian business example. If this is your first time seeing this series, go back and watch the previous lesson because we are building your bookkeeping knowledge from beginner level to professional level. Let's assume you own a pharmacy business in Abuja. A customer bought drugs worth 50,000 naira on credit. After getting home, the customer discovered that some of these products were damaged. The customer returned the product worth 10,000 naira. Now, this question is, should the customer still pay the full 50,000 naira? Of course, no. The pharmacy now prepare a credit note, what we call a credit note. A credit note is simply a document issued by a seller to reduce the amount owned by a customer. The seller is saying, because you return these goods, your debt has been reduced. So now let us see the practical example using Excel. Many business lose money because they don't keep proper returns goods. Some customer return goods and the business owner forget to update the records. At the month end, the sales report become inaccurate. This is why credit notes are important.